Silver just hit $102 an ounce in Shanghai. Not 92, not 95, 102. While most Western traders were still staring at screens showing prices in the mid-80s, the physical market in Asia was clearing real metal at triple digits. That gap is not random. It's not noise. It's not a headline trick. It's a signal. And if you're holding silver, trading it, or even just watching the macro environment, you need to understand exactly what just happened. Welcome back to Past and Profit. If you value clear, data-driven breakdowns without hype, hit like and subscribe in the first minute so you don't miss what's coming next. This channel is for people who want structure, not speculation. Now let's get into it. Shanghai silver futures opened at $99. Within hours, they pushed to 102. That's the print, 102. Meanwhile, Western spot silver was trading nearly $15 lower. Think about that for a second. Two major financial systems, one metal, a double-digit price gap. That is not normal behavior for a globally traded commodity. When you see a premium that wide between East and West, the first question is simple. Is this just volatility, or is this structural stress? Because volatility is random. Structural stress builds pressure. Let's break it down calmly. In normal markets, price differences between exchanges get arbitraged away quickly. If silver trades higher in one region, traders buy low in another and close the gap. That mechanism keeps the global price aligned. But when the gap holds, especially when physical lots are clearing at the higher number, that tells you something deeper is happening. Reports coming out of the Shanghai session showed that while the average close was slightly below the high, the final physical transactions were still clearing near that 102 level. That means real buyers were willing to pay it, not paper traders flipping contracts. Physical demand. Now compare that to the West. Western spot during that same window was soft. Volume was thinner than usual. Price action struggled below key resistance levels. On the surface, it looks weak, but when you layer that against triple-digit physical pricing in Asia, you don't see weakness, you see divergence. And divergence in commodities rarely lasts forever. Here's where it gets more interesting. The implied volatility index for silver options on COMEX has surged to levels not seen since the last explosive move. Volatility is the options market's way of saying something big is coming. It doesn't tell you directions with certainty. But when volatility spikes while price lags behind physical demand signals, that's tension building under the surface. The price is quiet, volatility is loud. Those two don't coexist peacefully for long. Now let's talk about positioning. Open interest heading into the next settlement window remains elevated. Millions of ounces in paper contracts are moving toward delivery timelines. At the same time, the amount of registered silver, the metal actually available for delivery, has not increased in a meaningful way. That ratio matters, because when paper claims grow faster than physical supply, the market becomes sensitive. Even small shocks can create oversized reactions. This does not mean a guaranteed squeeze. It does not mean prices must explode tomorrow. What it means is that the margin for error is shrinking. Zoom out for a moment. This is not happening in isolation. Crude oil has been climbing again, trading at levels that reintroduce inflation pressure into the system. Global energy supply constraints haven't disappeared. Geopolitical tensions remain active. And when oil and precious metals move together, that combination feeds inflation expectations across financial markets. At the same time, gold imports in India have hit record levels again. Asian demand for physical metals has been consistently strong for months. While some Western analysts call it speculation or momentum, the data shows something else. Sovereign buyers and institutions in the East continue to accumulate hard assets. When you combine record gold imports, strong Asian silver premiums, rising oil, and elevated options volatility, you don't get a random story. You get a macro picture. But here's where balance matters. Silver did spike to 102. It did not hold far above that level for long. There was selling pressure near the highs. That tells you traders are still willing to take profits at psychological levels. Triple digits is a milestone. Markets react to milestones. And volatility cuts both ways. If a broader risk-off event hits equities or credit markets, metals can temporarily drop with everything else. Liquidity events force selling across asset classes. We've seen that before. So this is not hype. This is not silver to the moon talk. This is structural observation. The key issue is the gap. Shanghai at 102. Western spot far below. Physical premiums elevated. Options, volatility elevated. Delivery ratios are tight. Energy prices are rising. Eastern demand is steady. At some point, that gap resolves. The question is how. Either Western prices move higher to meet physical demand signals, or Asian premiums compress back toward Western levels if demand cools. Those are the two paths. Markets always reconcile divergence eventually. Right now, what makes this moment different is the accumulation of signals happening at the same time. It's not just one indicator flashing. It's multiple layers aligning. Short-term traders are watching technical resistance zones carefully. Silver has tested certain price levels multiple times without a decisive breakout on Western charts. That tells you sellers are active there. A strong close above those zones with volume would change the short-term picture quickly. But the bigger narrative isn't about hourly candles. It's about structure. Paper markets are pricing silver one way. Physical markets in parts of Asia are pricing it another. When that disconnect widens instead of narrows, it gets attention. And here's something important for viewers of Past and Profit. The biggest mistakes in markets don't happen because people lack information. They happen because people let emotion distort what the data is saying. Some see 102 and feel euphoria. Others see volatility and feel fear. Both reactions can be expensive. The disciplined approach is simpler. Observe the numbers. Track the ratios. Watch the premiums. Monitor open interest into settlement dates. Let the structure guide you, not social media noise. Because when silver moves, it moves fast. Historically, breakouts in this metal are rarely slow and polite. They are sharp, violent, and often unexpected by the majority. That's why the volatility index matters so much. It's the market's insurance pricing. When insurance gets expensive, it's because risk is perceived to be rising, not falling. And remember, silver is not just a precious metal. It's an industrial input. It's used in solar panels, electronics, medical applications, and emerging technologies. Industrial demand doesn't disappear overnight. Supply expansion, on the other hand, takes years. Mining projects are capital intensive and slow. That creates structural tightness over longer time frames. Now combine that with investment demand spikes during inflationary periods. That's when silver becomes unpredictable. So what do you do with this information? First, you verify it yourself. Check exchange data. Look at volume reports. Watch settlement numbers. Don't rely on headlines. Data is public. Interpretation is what separates disciplined investors from reactive traders. Second, you manage risk. No single trade should define your financial future. Whether you're stacking physical silver, trading futures, or holding mining stocks, position sizing matters more than conviction. Third, you stay emotionally neutral. Markets test patience more than intelligence. Silver hitting 102 in Shanghai is a headline. But the real story is the structural pressure building underneath. That's the part that doesn't show up in quick news alerts. And if this breakdown helped you see the bigger picture more clearly, take a second to hit like and subscribe if you haven't already. It helps this channel grow and keeps Past and Profit focused on serious viewers who care about data over drama. As we move forward, watch how the east-west price gap behaves. Watch whether volatility stays elevated. Watch how many contracts stand for delivery versus how many roll forward. Watch oil. Watch gold imports. Watch the macro backdrop. Because markets rarely shout before they move. They whisper through data first. Silver at 102 might be remembered as a temporary spike. Or it might be remembered as the early stage of a larger repricing cycle. We don't predict. We prepare. And I want to hear from you. Do you think Western prices will catch up to Shanghai? Or do you believe premiums cool off from here? Drop your view in the comments. Real analysis only, no hype. Your perspective helps sharpen the discussion for everyone watching. If you found this valuable, share it with someone who follows metals but isn't looking at the structural side. The more disciplined voices in this space, the better. This is not financial advice. This is financial education. Protect your capital. Manage your emotions. Invest with logic, not impulse. Silver just printed 102. The question now is not what happened. The question is what happens next. Stay sharp, stay disciplined, and I'll see you in the next one.